the extent we should. And then inside the company, I just hope people say, we're going to miss the son of a bitch when he's gone. And he made the world a better place, and he created opportunity. And
imagine being so powerful that when you speak, the entire financial world stops to listen. Now imagine using that power to declare war on Bitcoin while secretly building an empire on the very technology behind it. This is the story of Jamie Dimon, the man who called Bitcoin a fraud while his bank invested billions in blockchain technology. And today, we're going to uncover the truth behind one of finance's biggest contradictions. What if I told you that one of the most powerful bankers in the world thinks Bitcoin is as dangerous as smoking cigarettes? That's right, Jamie Dimon, the CEO of JPMorgan Chase, just compared owning Bitcoin to smoking. But here's where it gets interesting. While Dimon calls Bitcoin worthless, his own bank is diving deep into blockchain technology. Today we're going to uncover several shocking revelations that might change how you think about Bitcoin forever. First, we'll dive deep into the real reasons behind Dimon's hatred of Bitcoin. You'll learn about his personal history with digital currencies and the events that shaped his perspective on cryptocurrency. Next, we're going to reveal the shocking truth about crypto crime statistics. The numbers I'm about to show you completely contradict what mainstream media wants you to believe about Bitcoin and illegal activities. Then I'll take you behind the scenes of how JP Morgan is secretly becoming a blockchain powerhouse. You'll see exactly what they're building and why it might be bigger than Bitcoin itself. We'll also explore why some of Bitcoin's biggest critics completely changed their minds. These aren't just small players, we're talking about billionaires and world leaders who once called Bitcoin a scam but are now its biggest supporters. Before we dive into the controversy, let's understand who Jamie Dimon really is and why his opinion matters so much. Born in 1956 in New York City, Dimon graduated from Harvard Business School in 1982. He was mentored by Sandy Weil at American Express and became CEO of JPMorgan Chase in 2005. He led the bank through the 2008 financial crisis and has been named one of Time's most influential people multiple times. Under Jamie Dimon's leadership, JPMorgan Chase has transformed into something truly remarkable. First off, JPMorgan Chase isn't just big, it's the largest bank in the United States. To put this in perspective, if JP Morgan were a country, its assets would make it the world's fourth largest economy, right behind Japan. Speaking of assets, the numbers are staggering. We're talking about over $3.8 trillion, that's trillion with a T. To help you visualize this, if you had $3.8 trillion in dollar bills and laid them end to end, they would circle the Earth over 15,000 times. But it's not just about size. Under Dimon's watch, JPMorgan Chase has become a true global financial powerhouse. They've expanded their operations to more than 60 countries across 6 continents. This means that at any given moment, while you're watching this video, JP Morgan is processing millions of transactions across every time zone on Earth. January 2024, Jamie Dimon appears on CBS News. The setting is formal, the stakes are high, and what he says next sends shockwaves through the crypto community. Quote, Bitcoin has no intrinsic value. It's heavily used by sex traffickers, by money launderers, ransomware. Let's break this down piece by piece. What defines intrinsic value? Does the US dollar have intrinsic value? How do we measure the value of digital assets? Then comes the smoking comparison. I applaud your ability to want to buy or sell it, just like I think you have the right to smoke, but I don't think you should smoke. Let's rewind the tape and look at Dimon's greatest hits against Bitcoin. In 2014, he called Bitcoin a terrible store of value, questioned its stability, and doubted its legitimacy. In 2017, we saw his famous fraud statement, where he threatened to fire any JP Morgan trader buying Bitcoin and compared it to the tulip mania bubble. In 2023, during his Senate hearing testimony, he called for government intervention and claimed crypto enables criminal activity. In 2024, he made his public decentralized Ponzi scheme comment, dismissed Bitcoin ETF approvals, and maintained his anti-crypto stance despite market growth. Now here's where things get really interesting. While Dimon maintains his anti-Bitcoin stance, JP Morgan has been building an impressive blockchain empire. Let's dive into one of JP Morgan's most fascinating blockchain projects, Kinexys, formerly known as Onyx. At its core, Kinexys is JP Morgan's answer to a multi-trillion-dollar problem in finance: how to make real-world assets as easy to trade as cryptocurrency. They're doing this through something called asset tokenization. Think of asset tokenization like this. Imagine you own a $1 million building. Traditionally, if you wanted to sell just 10% of that building, you'd be drowning in paperwork and legal fees. But with tokenization, that same building can be split into digital tokens, like cutting a pizza into slices. Each token represents partial ownership of the building, and these tokens can be bought and sold as easily as sending an email. Here's how it works, step by step. First, the physical asset is legally structured to allow fractional ownership. Smart contracts are created to govern the rights and rules of the tokens. The asset is tokenized on Kinexys' blockchain platform. These tokens can then be traded 24/7 on digital marketplaces. Now, let's talk numbers because this is where things get mind-blowing. In 2023, the tokenization market was worth about $600 billion. Impressive, right? Well, hold on to your seats. By 2030, just 5 years from now, experts predict this market will explode to $10.9 trillion. That's not just growth, that's a financial revolution. And here's the kicker, real estate is expected to dominate this market. We're talking about 33% of all tokenized assets being real estate. That means nearly $3.6 trillion worth of buildings and property will be traded as tokens. Let's shift gears and talk about something that might sound contradictory coming from a Bitcoin critic. Launched in 2019, JPM Coin is JPMorgan's own digital currency. But before you say, wait, isn't this exactly what Dimon criticized? Let me explain why this is different. Unlike Bitcoin, JPM Coin is what we call a stable coin. It's always worth exactly $1. Think of it like a digital version of the cash in your bank account. Every JPM coin is backed by real dollars held in JP Morgan's accounts. Here's where the numbers get interesting. As of late 2023, JPM Coin was processing over $1 billion in transactions every single day. Let that sink in, a bank that criticizes crypto is moving the equivalent of El Salvador's monthly GDP through its own digital currency system daily. The technical architecture is fascinating. Built on their custom blockchain called Quorum, it uses military-grade encryption, processes transactions in seconds, not minutes, and operates 24/7, unlike traditional banking systems. Here's a real-world example. Imagine a company in New York needs to pay a supplier in Singapore. Traditionally, this would take 2-3 business days, multiple intermediary banks, high fees, and be limited to banking hours. With JPM Coin, you get settlement in minutes, direct transfer, minimal fees, anytime, any day. And here's what sets JPM Coin apart from other stable coins like Tether or USDC, it's only available to institutional clients, fully regulated from day one, has direct integration with existing banking infrastructure, and is backed 1-1 with actual USD and JP Morgan accounts. Now, let's explore one of JP Morgan's most ambitious projects yet, Project Guardian. In 2023, JP Morgan partnered with Apollo and the Monetary Authority of Singapore to revolutionize how asset management works. But this isn't just another banking initiative. This is about fundamentally changing how $100 trillion worth of assets are managed globally. Let me break down exactly what Project Guardian is trying to achieve. First, imagine the current asset management world, hundreds of manual processes, armies of people checking and rechecking paperwork, days or weeks to execute complex trades, millions spent on preventing errors. Now, here's where smart contracts come in. Think of smart contracts like digital robots that automatically execute trades when conditions are met, verify compliance in real time, handle settlement instantly, and never make manual errors. The benefits are staggering. We're looking at 50 to 70% lower operating costs, elimination of manual reconciliation, and reduced need for intermediaries. In terms of speed improvement, we're seeing settlement time reduced from days to minutes, real-time portfolio rebalancing, and instant compliance checking. For risk reduction, we get automated compliance, reduced human error, and real-time risk monitoring. Time to fact-check Dimon's biggest criticism: crypto's role in criminal activity. Let's tackle one of Dimon's most serious accusations head-on, the claim that crypto is primarily used for criminal activity. To do this, we're going to look at hard data from Chainalysis, the world's leading blockchain analysis company. The numbers I'm about to show you might shock you, especially if you've been listening to mainstream media. Let's start with the total volume of cryptocurrency transactions in 2023. Total crypto transactions reached $7.1 trillion. That's more than the GDP of the United Kingdom and represents millions of daily transactions worldwide. Now, here's where it gets interesting. Out of all these transactions, guess how much was linked to illicit activity? Just 0.34%. Let me put that in perspective. For every $1,000 in crypto transactions, only $3.40 was linked to illegal activities. The other $996.60 was completely legitimate. But it gets even better. This 0.34% represents an improvement from 2022, when it was 0.42%. That means crypto is actually getting safer over time. Let's break down the types of illicit activity. Scams represent 31.5%, darknet markets, 25.8%, ransomware, 15.4%, fraud, 14.2%, and other activities, 13.1%. What's particularly interesting is that as cryptocurrency adoption has grown, the percentage of criminal activity has decreased, tracking capabilities have improved, law enforcement has gotten better at catching criminals, and legitimate use cases have exploded. But here's where Dimon's argument really falls apart. Let's compare crypto with traditional finance. According to the United Nations Office on Drugs and Crime, the numbers for traditional finance are staggering. First, let's look at the total scale. Between 2 to 5% of global GDP is laundered through traditional banking. That's $1.70 to $4 trillion annually. Remember crypto's 0.34%? This is nearly 15 times higher. Let's break this down by payment method. Cash remains king for criminal activities at 87%. Traditional banking transfers account for 9.7%, cryptocurrency represents just 0.34%, and other methods make up 2.96%. Traditional banking systems are vulnerable to crime because of several factors. Privacy laws make bank secrecy harder to penetrate, with different regulations by country and limited international cooperation. Complex networks involve multiple intermediary banks, cross-border transactions, and correspondent banking relationships. Cash intensity means untraceable physical currency that's easy to transport in bulk and hard to track once converted. Now let's address something that might surprise you. Blockchain technology is actually one of the most powerful tools we have for fighting financial crime. Unlike traditional banking, where money can seemingly vanish into thin air, blockchain creates what we call an immutable ledger. Imagine every financial transaction you've ever made being recorded in a gigantic public book that can never be erased, can never be altered, can never be hidden, and is visible to everyone, everywhere, all the time. Here's a real-world example of how this works. In 2022, hackers stole $625 million from Axie Infinity, a popular blockchain game. They thought they'd gotten away with it. But here's what actually happened. Every movement of the stolen funds was tracked in real time. Law enforcement could see exactly where the money was going. When they tried to convert to cash, exchanges were ready, and the FBI eventually traced it back to North Korean hackers. The crypto industry has undergone a remarkable transformation when it comes to security and regulation. The early Wild West days of 2009 to 2014 had limited to no KYC requirements, minimal exchange security, few regulatory frameworks, and high-profile hacks were common. From 2015 to 2018, we saw the first wave of regulation, with major exchanges implementing KYC, the birth of blockchain forensics, initial regulatory frameworks, and security standards emerging. The maturation phase of 2019 to 2022 brought advanced KYC AML systems, exchange security improvements, and regulatory compliance. Today we have institutional-grade security, with bank-level protocols, real-time threat detection, cross-platform monitoring, and international regulatory coordination. The results speak for themselves: 98% reduction in exchange hacks, 76% decrease in unauthorized access, 89% improvement in threat detection, and 92% of trading volume on regulated platforms. Now let's dive into one of the most fascinating aspects of the crypto story: the complete transformation of some of its biggest critics. Donald Trump once said, "I am not a fan of Bitcoin and other cryptocurrencies which are not money and whose value is highly volatile and based on thin air." Fast forward to 2024, and we see him actively promoting crypto-friendly policies, planning executive orders to support crypto innovation, calling for American leadership in digital assets, and suggesting crypto-friendly appointments to key positions. Similar transformations happen with other prominent figures. Larry Fink, CEO of BlackRock, went from calling Bitcoin to operating the largest Bitcoin ETF and holding 554,000 BTC worth $53.78 billion. Michael Saylor transformed from a Bitcoin skeptic to the largest corporate Bitcoin holder with 450,000 BTC. Looking to the future, we're seeing major developments in traditional finance integration, with major banks offering crypto custody, stock exchanges launching digital asset platforms, investment firms creating crypto products, and traditional brokers adding crypto trading. The future holds even more promise, with hybrid banking systems offering instant cross-border payments, 24/7 market operations, programmable money, and smart contract-based lending. The asset tokenization revolution will bring real estate tokens trading like stocks, fractional ownership of everything, automated dividend distributions, and real-time settlement of trades. As we conclude our investigation into Jamie Dimon and Bitcoin, one key question remains: is Dimon's criticism masking a deeper strategy? Could JPMorgan become a crypto leader despite his stance? And what does this mean for the future of Bitcoin? Thank you for watching this deep dive into one of finance's most fascinating contradictions. If you found this analysis valuable, hit that like button, subscribe for more deep dives, and share your thoughts in the comments below. Stay informed, and I'll see you in the next video.